amid growing concerns about economic growth.
Consumer spending was
As
soft.
expected, cut interest rates another quarter point.
We are following breaking news. All three major American stock markets have closed down.
Bitcoin rose 10%.
Even gave the stock market a temporary second win.
The market reaction, it was kind of nonplussed.
Tariffs going into effect tomorrow.
But the NASDAQ was also.
Investors will be watching closely for more clues about the direction.
It's time to tune out the noise and tune in to great information with A Steward's View. Expect valuable economic updates, investing techniques, and planning concepts that move you to be wise and decide well. You'll be equipped and encouraged in a stewardship mindset, managing God's resources 1 week at a time. You can listen to this podcast and previous episodes at astewardsview.com.
Welcome back. I'm Aaron Kolkman. That's Chaz Louder, and this is A Steward's View. So glad you joined us again. Remember to visit this and previous episodes online at astewardsview.com or on your favorite podcast platform. Coming up this summer, ASV moves to videocast and ASV Plus becomes available. And another summer 2025 bonus. Get the Life Cycle of Wealth book refresh online at astewardsview.com or at major booksellers nationally. For now, you can pick up the Life Cycle of Wealth in its current edition online without a fee at fideradvice.com/lifecycle. That's FIDERE advice.com/lifecycle. Looking back to last week, U.S. equity indexes posted mixed performance as investors weighed optimism around trade negotiations against an uncertain outlook from the Fed. The S&P 500 and NASDAQ composite indices fell marginally, while the Russell 2000 finished slightly positive. S&P 500 sector returns were also varied, but healthcare slumped more than 4%, pressured by the potential impact of pharmaceutical tariffs. Cryptocurrencies, meanwhile, benefited as investors' risk appetites increased, with Bitcoin jumping 6% to nearly $104,000 per coin. Ethereum soared by a whopping 26%, and then crude oil prices also recovered from a sharp drop on Monday to finish higher by more than 4%, back above $60 per barrel. And gold futures surged early in the week before pulling back, settling into a 2.6% gain. Meanwhile, U.S. Treasury yields rose after mixed auction results and the Fed's decision to leave short-term rates unchanged. While the 10-year auction saw strong demand, 30-year bonds sold off, sending yields higher as foreign purchases came in at the lowest percentage of the total since 2019. The FOMC statement said that the U.S. economy has continued to expand at a solid pace, but the risks of higher inflation and unemployment have risen. Expectations for additional rate cuts have shifted out to July, according to Fed funds futures, as the uncertainty from tariffs has clouded the economic outlook. The broad outline of a trade agreement between the U.S. and United Kingdom sparked hopes for future deals, though the way forward for nations with which the U.S. has a large trade deficit remains unclear. Initial meetings with China were scheduled over the weekend in Geneva and are seen as a first step in a long process to de-escalate trade tensions. In other economic news, ISM Services PMI increased in April to 51.6, with the prices paid gauge rising to a two-year high of 65.1. Non-farm productivity fell at 0.8% annualized for the first quarter, the first decline since quarter two of 2022. And unit labor costs jumped at 5.7%, up from 2.0% in the prior period. Overseas, China's central bank lowered its benchmark interest rate by 10 basis points to 1.4% and cut the reserve requirement for domestic banks by 0.50%. China's exports to the U.S. fell by 21% in April, but overall exports still rose 8% year over year as the country shifted sales to Southeast Asia. The Bank of England lowered rates by a quarter point to 4.25% in a much closer than expected 5-4 vote. And finally, Germany avoided the possibility of confidence-shaking political turmoil, electing conservative leader Merz as new chancellor after requiring a second round of voting. Last but not least, Eurozone investor confidence improved this month as recession fears receded. Now let's get going. This week on A Steward's View, we've spent about 2 months walking through major economic and market changes. There has been some big news today in the conversation about tariffs between the U.S. and China. And to quote Bloomberg, just today, May the 12th, Xi defiance pays off as Trump meets most Chinese trade demands. Well, that is a fairly one-sided headline, but the good news is that there's a truce. It's a temporary 90-day agreement, and it looks like this. After 2 days of talks in Switzerland, the U.S. and China announced a massive de-escalation in tariffs, with the U.S. slashing duties on Chinese products to 30% from 145% for a 90-day period, and Beijing drops its levy on most goods to 10%. So there's good news on both sides there, according to my thinking, and that's what we really needed to see. The market wanted to see, actually, when it comes to the desires of this market. We have a healthy market in fundamental terms, and I haven't said that nearly enough in this program. It has wanted to go higher. It's needed a reason to go higher, and it most definitely needs certainty to go higher. So it has done that today. We had a big increase today of just in one day, 3.26% for the S&P 500. So some good news there. This conversation is not over, certainly between the two nations and really any of the U.S. trading partners, but it's a step in the right direction, and the market is getting the certainty that it wants. So let's spend the rest of today's segments on one of the topics that has been planned for months before A Steward's View even started. And it's going to come to the core of what happens when we connect economics and all of the extra contextual things that we talk about with investing and investing with planning. In the middle of those three, economics, investing, and planning elements of this program, investing is right there. Okay, so we've said already many times that investing and trading are different. Trading is the effort to make a quick buck, to do something, to place a trade, to buy and to sell, to transact regularly with the idea of making short-term profits. Okay, and that's a different thing than making long-term investments. So long-term investing is meant to fund long-term goals. That's the difference, right? We don't typically need trades to fund short-term goals, right? So let's be clear about what we are not talking about, and that's some kind of trading every day or every week that's meant to generate a quick buck. All right. So when we look at long-term goal funding, there are many things that I could say about that in this program, but I'll say this. We've talked a little bit about consistency investing, and there's more to talk about there. We haven't talked a lot about the why that's helpful, and so there are a couple of reasons that I want to go into as to why consistency investing is such a help to those who are trying to fund long-term goals. So let's use an example. If I say, well, I see my work life changing in about 20 years, and at that time, I'm going to have a different picture, a different life picture, routine, yes, financial picture, but some major variables in my life will be different. My family will have grown. I may be in a different home. I may live in a different place, location, whatever, and my work is going to change. Okay, so transitions ahead, and we know something about that. We've planned, we've talked about that. We've got the life goals written down. We have the financial, the numbers attached to those life goals. So the financial plan is in process, and then we say, okay, well, we've got X amount of capital available now to fund a future goal. When we strip away inflation, when we strip away other detractors from goal funding or long-term goal funding, that would be like unnecessary expenses, things that are going to eat away at our ability to save and invest. And then once we're saved and invested, the return on those investments. Okay, so we're going to try to dial in on how much capital is actually available for investment today, how much can be added, and then to try to eliminate any unnecessary detractions from the current or new capital that gets invested. Okay, not sure if that's all completely clear, but I'm trying to articulate that we have this current capital, this additional capital that'll get added over time, while we we sort of set aside, we'll factor in inflation, and then we'll set aside regular living expenses in order to isolate what we have saved and can save, right? What we have invested and what we can invest. All right. And for the purposes of this conversation, I'm putting saving and investing into the same realm, right? So long-term capital. So when we figure out what that looks like, then we need to figure out what to do with our long-term capital. Now, this is where everything gets really noisy really fast. And I'll start with the comment that what we really want to do is to take the goal or goals, and I used an example of 20 years out and a series of life changes and some knowledge of what that looks like and what it costs, right? Compared with current capital and additional capital that we're now talking from. So when we try to connect those dots, the number one thing we can do to stay disengaged from headlines, from digital noise, from trading conversations, is to understand what the plan actually requires, right? So it's a pretty well-known practice for most financial offices to go out and say, well, here, Mr. Mrs. prospective client, or Mr. Client, Mrs. Client, let's figure out what your risk profile is, your ability to take risk and your willingness to take risk. Okay. And here's 5 or 10 questions, or however many questions. And look, let's see, you're a moderate investor. So we're going to have a balanced portfolio. Okay. Well, historically, balanced portfolios have generated, let's say it's 7 to 9% per year. It's a reasonable expectation, okay, before inflation. Well, what does the plan actually require? What if the plan requires 6%? And now your portfolio, can you tolerate the 8? Yeah, well, on paper you can. But the 6% your plan requires is actually the first number that we need to consider, right? Because why take on extra risk that your plan doesn't require? There might be good reasons. You might actually do it. You might say, well, gee whiz, after inflation, I really want to leave behind a legacy for my kids and grandkids. There are extra considerations beyond what I'm doing in this first generation. Okay, that makes a lot of sense. Maybe you have giving goals. We haven't really touched on what planned giving looks like in this program, and that'll be a whole new chapter of the life cycle book that's coming up. So when we consider what the plan requires first, and then consider what your risk profile or your investor profile looks like, then we can start to get an idea of what the future could hold when it comes to your returns. Your returns on what? Current capital and capital added as time goes on. So that's a good place to start. After that, there's really 2 conversations that need to be had. And we'll only touch on one of those today in the second segment, and that is total return investing. The other one is passive versus active investing, or index versus active investing. I've touched on that in the past, and we'll come back to that in a future session. But for now, I want to come back and we'll talk about total return investing in just a moment.
More of A Steward's View in just a moment. Investors have stocks, bonds, mutual funds, ETFs, options, futures, real estate, and more. There's one place to look at all of your portfolio. It's called Fusion, Portfolio Aggregation. No contract, no hassles. Fidere's portfolio technology gives its users a chance to see all of their assets all the time, wherever they are. The Fusion platform is open for use without a contract and without a hitch. It's based on mean variance optimization and analysis research by Aaron Kolkman. Fidere uses the Fusion platform to optimize assets for its clients. For more information, visit fidereadvice.com and click on Fusion at the top of the page. That's Fidere Advice, Fidere advice.com. Now back to A Steward's View with your host, Aaron Kolkman.
Let's talk about total return investing. This is a critical conversation for investors, and I suspect this won't be the only time we talk about it, but I want to lay the groundwork. When we take in any vehicle, an equity vehicle, a bond or fixed income vehicle, an alternative investment vehicle, and we say, I'm going to use this vehicle as the vessel or the vehicle to hold capital, right? An exchange traded fund, a mutual fund, a separately managed account, an individual security, stock or bond, to move my plan forward, to fund my goals with my existing asset base and that whatever I'm going to add to it. When we do that, we need to understand the different kinds of returns that are available to us. Okay, and that has a lot to do with what the vehicle is, for sure, but also what the vehicle's holding, right? Is it holding stock? Is it holding bonds? Is it holding real estate? Is it holding gold? Okay. I don't really want to make a presentation for how my firm does things. I want our investors to understand what comes out of either any given vehicle and any given set of holdings inside. So let's use an example. If we have an ETF, an exchange traded fund, that fund trades on the open market. It might hold 30 stocks. Those might be growth stocks, and they might send very little in the way of dividends. They might have a lot of increases in value or appreciation, and that might be the goal of that particular exchange traded fund, or a mutual fund that doesn't trade on the open market that does the same thing. Okay. Now, appreciation that I just mentioned is one kind of return, right? What I have, my asset can grow. The other kinds of return, I mentioned dividends. We can get a dividend. We can get a capital gain even, right? We can have capital gains come out that are recognized gains from particularly mutual funds and ETFs, but we can very often see those gains come out. Okay. So whatever I'm holding can go up. It can generate a gain that gets sent out, just like it can generate a dividend that gets sent out. And, in the case of bonds, I could get an interest payment that gets sent out. So there's these different forms of income that can be had for investors, whether we're directly holding securities or we're holding them in the types of vehicles I mentioned. And the first question in that analysis, well, there's two. The first two questions are, what kind of income is it? And the second one is, what am I going to do with it? Okay. So this may not, if you have a really, experienced advisor that knows you and knows your goals, you may not have to decide this. If you're doing a lot of self-directing or you aren't sure, it may be a good idea to check in with yourself or your advisor to understand what are the income sources. If I have this income, something besides appreciation or rising in value in my holdings, what types is it and what's being done with it, right? Because what are my two choices? Chaz, you're over here. What are my two choices with any income that I get from my portfolio? What do you suppose they would be?
From an asset, from a holding?
Yeah.
I can either reinvest it or I can hold it or cash it out.
There you go. Okay.
Yeah.
So and maybe we should play this out a little bit. How do you, Chaz, know which one is better?
Well, I'm a risk guy.
Yeah. Okay. So you'd be willing to take more risk, you're saying?
I'm a doubling it down kind of guy. My wife would be like, no.
Right, so let it ride. Okay. Well, let's understand that the income that comes off of an investment, whether it's a gain distribution from a fund, a dividend paid from a stock or a fund, an interest payment from a bond or a bond fund, those income sources or items are paid and kept one way or the other, right? They could either be kept as cash, like you said, right? And that would be taking the chips off the table in the gambling analogy, which we're not doing. Or you could reinvest them, right? You can continue. So total return investing just simply says take everything you got and keep going, right? Reinvest. Why? Well, there are a lot of whys they could give you, but just in basic form, total return investing means that we're going to take every bit of gain, every dividend, every capital gain distribution, every income item, interest, whatever, and reinvest it so that we can see sort of one return happen over time. Now, could we still calculate the return if we took the income? Yeah, sure. In fact, that income is taking risk off the table, to your point, Chaz, right? And we can add that back to total return, whether we reinvested it or not. But with total return investing, something really unique can happen. We can start to say, okay, and I'm going to use an example. The gain in a given year was 5%. The income payments received from the investment was 3%. We got the moderate investor over here. And so now I have an 8% return. Inflation was 0, so I got to keep all 8%. Okay. In that analysis, I can say very easily, well, I'm going to withdraw if I'm in that stage of life, right? So now let's just jump forward 20 years. Whether you reinvest it or not along the 20, I think, unless you need the income, reinvest. I mean, that's the simple answer. But my comment is when we get to the 20-year point, when all these life changes were expected and they're actually happening, and I've been in this 25 years, so I have seen this with some people, okay? The amazing thing is we can say in a given year, well, I've got my total investment return year over year still working for me at the same time as I'm going to take a withdrawal from my principal, okay? And why is that important? Because if I took just the income out, and I see this a lot, so retirees, probably should have started here. Retirees will say, well, I want a predictable income stream. Okay. There are lots of programs, and I mean really well-known, really respectable programs in podcast land, in investment, with reps, advisors all over the country you can go to for dividend investing, and you can live on, you can clip that coupon, all those income items, dividends from stocks, interest from bonds, and you just live on that. Okay. Now, what if the dividend changes? What if the stock price changes and you're just clipping, or the bond price changes and you're just clipping this income off every year? Isn't that also going to change? Yeah. So the trouble isn't, well, one is just better than the other. The trouble is that it's hard to predict, or it's less predictable, what I'm going to have available to me if I rely on that income to live, right? So the big issue in the 8% example is, well, if income was 3% this year and it's only 2% next year, now I have to dip into a little bit of my principal. That's okay. I could do that. But what if we just said, look, we expect this whole thing on average to generate 7 to 9% per year. We're going to live on 4 or 3 or 5%, whatever we're going to live on, and we're going to project that out and not change it. That is a very straightforward answer to the what and the why of particularly creating income from portfolios, but it justifies in large part why total return investing is so important for accumulation, like during the 20-year period mentioned, and then taking income from the portfolio. So I hope that makes sense. There's a lot with total return investing that we could go into, but suffice it to say, the types of income are also important. We'll talk about that in the next week or two. Taking income in addition to appreciation and putting it all together and taking one reinvested sum and then drawing out, when the time comes, drawing out income from that is the most consistent way to generate a return and then take income, if that makes sense. Okay. So the income, if you took it as cash, you needed it, no problem. Whether you reinvested it or not, it's taken risk off the table, to your point earlier, Chaz. But I really want to emphasize, particularly when we get to the 20-year point, or in this example of the 20-year life changes that are going on, and they're happening now, the predictability of total return investing is much higher. I don't want to dismiss dividend investing at all, but it's extremely volatile at times for people who want to have a predictable thing. So I hope that's helpful as a way of thinking about what you're doing with your own path and the holdings that you have, the capital base that you're working with. With that, it's been such a pleasure to be back with you. I do hope this session has been a benefit to you and others you decide to share it with. We invite you to interact with us on Apple, Spotify, and Amazon, even social media. We did, Chaz, replace SoundCloud with Amazon. We love our friends at SoundCloud, but they weren't able to take us in just as a podcast. So you can visit our hosted podcast page and schedule with our sponsor, Fidere Advisors, at astewardsview.com. From all of us at A Steward's View, we look forward to connecting with you again next week. Until then, please do be wise and decide well.
You've been listening to A Steward's View. To learn more about Fidere Advisors or speak with Aaron, visit fidereadvice.com. That's FIDERE advice.com. To listen to this and other episodes of A Steward's View, visit astewardsview.com. A Steward's View is brought to you by Fidere Advisors, a registered investment advisor offering financial planning and asset aggregation. Asset aggregation systems are designed to align portfolios across accounts into a single, globally optimized investment plan for families it serves. Fidere maintains liquidity of client capital at major custodians and utilizes asset managers that have shown consistent historical performance through excellent risk management. This program is not an offer to transact any securities and does not constitute a financial planning engagement. Information provided has been prepared from sources believed to be reliable, but is not guaranteed and does not represent all available data necessary for making financial decisions and is for informational purposes only. Fidere and its representatives do not offer tax or legal advice through Fidere. Please consult the appropriate advisor. Fidere Advisors LLC is a registered investment advisor. To discuss your situation or to learn more about Fidere, please visit fidereadvice.com. That's FIDERE advice.com.